Often, people believe that banks simply hold on to the money that customers deposit, but that's far from the truth. This common misconception stems from a basic understanding of what a bank is, a safe place to store your hard-earned cash. But in reality, banks are much more dynamic and integral to the economy. Let's take a moment to address some of these misunderstandings. The first one being that banks are simply vaults filled with money. In reality, when you deposit your money in a bank, it doesn't just sit there. Your money is put to work. Banks use the deposits they receive to make loans to other customers. So, while your money is safe and readily available to you, it's also helping others buy homes, start businesses, or pay for education. Another widespread belief is that banks can magically create money out of thin air. Now, wouldn't that be something? But alas, it's not that simple. While it's true that banks can lend more money than they physically have in deposits, this isn't because they're conjuring money from nowhere. It's due to a system called fractional reserve banking. This system allows banks to lend a fraction of their deposits while keeping the rest as reserves. So while it may seem like money is being created, it's actually just being circulated more efficiently. Now let's touch on the myth that banks only benefit the wealthy. This is far from the truth. Banks provide services that benefit everyone. From the college student opening their first savings account to the small business owner seeking a loan to expand their business. Banks play a vital role in helping people manage their finances, save for the future, and invest in their dreams. So as we can see, banks play a much more active role in the economy than simply storing money. They are dynamic institutions that facilitate economic growth, encourage financial stability, and provide essential services to all segments of society. Now, you might be wondering, what exactly do banks do? Well, they play a multitude of roles, and each one is crucial in maintaining a healthy, thriving economy. Firstly, banks provide a safe haven for your hard-earned money. Instead of stashing bundles of cash under your mattress, you can deposit it into a bank. This not only keeps your money secure, but also makes your financial transactions smoother and safer. But banks aren't just glorified piggy banks. They also function as intermediaries in the economy. When you deposit money, it doesn't just sit idle. Banks lend out a portion of these deposits to individuals and businesses who need it. This could be someone taking out a mortgage to buy a house, or a business securing a loan to expand its operations. This lending activity is a significant contributor to economic growth. It enables individuals to make big purchases and businesses to invest, expand, and hire more people. All of these activities stimulate the economy, leading to growth and prosperity. Banks also play a crucial role in facilitating transactions. Every time you swipe your card at a store or pay a bill online, there's a bank working behind the scenes to make that transaction possible. This facilitation of transactions, both big and small, is vital for the economy to function smoothly. Moreover, banks help manage the money supply in the economy. By adjusting interest rates and the amount of money they lend, banks can influence the level of economic activity. In times of economic downturn, banks can stimulate the economy by lowering interest rates and increasing lending. Conversely, in times of rapid economic expansion, banks can cool down the economy by raising interest rates and reducing lending. This balancing act helps prevent the economy from overheating or falling into a recession. Therefore, banks are more than just vaults for your cash. They're key drivers of economic activity. To understand how banks operate, we need to delve into some basic economic theories. Let's start with the principle of supply and demand. If we think of money as a commodity, just like apples or cars, then its value can fluctuate based on how much of it is available and how many people want it. When a bank has plenty of money to lend, the cost to borrow that money, known as the interest rate, can decrease. Conversely, when there's a high demand for loans and a limited supply of money to lend, the interest rate can increase. Next, let's talk about interest rates. Simply put, an interest rate is the cost of borrowing money. When you take out a loan, the bank charges you a percentage of the loan as a fee for their service. This fee is what we call interest. But interest rates don't just affect loans. They also impact how much money you earn on your savings. When interest rates are high, your savings grow faster because the bank pays you more for keeping your money with them. Inflation is another key economic theory that plays a significant role in banking. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. If inflation gets too high, the bank might raise interest rates to slow down the economy. On the other hand, if inflation is low, the bank might lower interest rates to stimulate spending and investment. The relationship between these three economic theories, supply and demand, interest rates and inflation, is complex and interdependent. Changes in one can lead to changes in the others, creating a ripple effect throughout the economy. For example, if a central bank decides to increase interest rates to control high inflation, this could lead to a decrease in demand for loans, as borrowing becomes more expensive. This in turn could lead to a decrease in supply as banks see less demand for their primary product, money. These theories provide a basic framework for understanding how banks operate. They help us understand why banks might change their interest rates, how they react to changes in the economy, and how their actions can affect us as consumers. Banks play a key role in managing the supply of money, setting interest rates, and trying to keep inflation at a manageable level. They're like the conductors of an economic orchestra, keeping everything in harmony. With these economic theories in mind, we can better understand how banks function and how they impact our daily lives. So next time you see news about interest rates or inflation, you'll have a clearer understanding of what's happening behind the scenes in the world of banking. Scene script. Let's bring these theories to life with some real-world examples. Imagine you're a homeowner with a variable interest rate mortgage. You've been enjoying low payments for a while, but then the central bank decides to raise interest rates to slow down the economy and prevent inflation. Suddenly, your monthly mortgage payments increase, and you have less money to spend on other things. This is a real-life example of how changes in interest rates can affect loans. On the flip side, let's say you're a saver who has put away a good sum of money in a savings account. When interest rates rise, you'll earn more on your savings, which is great news for you. But if you were planning to take out a loan for a new car or a home improvement project, you might decide to put that off because borrowing has become more expensive. Now let's talk about inflation. Inflation is the rate at which the general level of prices for goods and services is rising. Essentially, it decreases the purchasing power of your money over time. Picture this. You've tucked away $100 in your sock drawer for a rainy day. A year later, you decide to spend it. But due to inflation, the price of the things you want to buy has gone up. That $100 doesn't stretch as far as it did a year ago. You can still buy things with it, but not as much as before. This is how inflation erodes the value of money over time. Consider another scenario. You're a business owner who bought a machine for $1,000 5 years ago. Today, due to inflation, that same machine costs $1,200. If you were to sell your 5-year-old machine for $1,000 today, you'd actually be losing money in real terms because you wouldn't be able to replace it with a new one without adding $200 more. These examples illustrate how changes in interest rates and inflation can have a real impact on our daily lives, affecting everything from our monthly mortgage payments to the value of our savings and the cost of our business investments. Economic theories aren't just abstract concepts discussed in textbooks. They're at work in our everyday lives, shaping our decisions and the world around us. When we understand these theories and how they operate in the real world, we're better equipped to make informed decisions about our money. By connecting these economic theories to real-life situations, we can see their impact and relevance. Now that we've covered some basics, let's tackle some common questions about banking. One question that often comes up is, why do banks charge fees? Well, the answer is fairly simple. Banks are businesses, and like all businesses, they need to make a profit to stay afloat. Fees are one of the ways banks generate revenue. These can come in the form of monthly service fees, overdraft fees, ATM fees, and more. It's also worth noting that maintaining a bank, both physically and digitally, requires resources. These fees help cover the cost of those resources, ensuring that your money is safe and accessible whenever you need it. Another common question is, why do interest rates vary between banks? Interest rates are essentially the price of borrowing money. Banks use interest rates to attract customers. Lower rates for loans can attract borrowers, while higher rates for deposits can attract savers. It's a delicate balance to strike. But interest rates aren't just pulled out of thin air. They're influenced by a variety of factors, including the state of the economy, inflation, and the policies of the central bank. Each bank has its own strategy for setting interest rates, which is why they can vary from bank to bank. Now, let's address a question that's on many people's minds. How do banks make money? Banks make money in several ways. One of the main ways is through the interest they charge on loans. When you take out a loan, you're required to pay back the amount you borrowed, plus an additional amount known as interest. This interest is essentially the bank's profit. Another way banks make money is through fees, as we discussed earlier. Banks also earn money through investing. They take the deposits they receive and invest them in various ways, such as buying government bonds or lending to other banks. The return they get on these investments is another source of income. Finally, banks make money through what's known as the interest rate spread. This is the difference between the interest rate they charge on loans and the interest rate they pay on deposits. The larger the spread, the more money the bank makes. In essence, banking is a complex business that involves balancing risk and reward. Banks must carefully manage their assets and liabilities to ensure they stay profitable while also providing valuable services to their customers. Hopefully, these answers have shed some light on some of the inner workings of banks. Banks have been around for centuries, but what does the future hold? As we head deeper into the 21st century, technology is reshaping the way we bank, and it's doing so at an unprecedented pace. Consider the rise of online and mobile banking. Not long ago, paying a bill or transferring money required a trip to a physical branch. Today, we can carry out these tasks from the comfort of our homes or even on the go, with just a few taps on a smartphone. This digital transformation is not just about convenience, it's also about expanding access to financial services. Now, people living in remote areas, or those who can't easily visit a bank, can participate more fully in the economy. But the technological revolution in banking isn't stopping there. The potential of blockchain technology and cryptocurrencies is becoming increasingly apparent. Blockchain, the technology underpinning cryptocurrencies like Bitcoin, offers a new way to record and verify transactions. This could make banking more transparent, efficient, and secure. Meanwhile, cryptocurrencies could reshape the way we think about money, turning it into a purely digital entity that's not tied to any specific country or central bank. As for the banks themselves, they're recognizing these trends and are racing to adapt. Many are investing heavily in technology, developing their own digital platforms, and even exploring the use of blockchain and cryptocurrencies. They're also forming partnerships with fintech startups, combining their financial expertise with the tech savvy of these new players. But it's not just about technology. Banks are also evolving to meet changing customer expectations. They're focusing more on providing a seamless, personalized experience, using data to understand their customers better and offer tailored products and services. So, while the world of banking may seem complex, it's also evolving and adapting to the needs of its customers. The future of banking may be digital, decentralized, and data-driven, but at its core, it will always be about serving the needs of people. This is the exciting future we're heading towards, and it's closer than we might think. Let's bring all of this together and summarize what we've learned. We've taken quite a journey, delving deep into the world of banking and its role in our economy. We began by dispelling some common misconceptions about banking. We learned that banks are not just places to store money, but vital institutions that play a significant role in the economy's functioning. They facilitate transactions, provide credit, and help in the creation of new money through fractional reserve banking. We then moved on to basic economic theories related to banking. We examined the concept of supply and demand in the context of interest rates, and how banks use this principle to balance lending and borrowing. We also discussed the multiplier effect, showing how banks can effectively create money by lending out a portion of their deposits. Using real-life examples, we brought these theories to life. We saw how interest rates can affect consumer behavior and how this, in turn, impacts economic growth. We also explored instances of the multiplier effect in action, demonstrating the ripple effect that banking can have on the economy. And we didn't leave it there. We delved into some of the most common questions about banking, providing clear, concise answers. We tackled questions about bank profitability, the safety of deposits, and the impact of digital technology on banking services. Finally, we looked to the future, discussing how banking is likely to evolve in the coming years. We forecasted a world of banking that is more digital, more personalized, and more integrated with our everyday lives. With this knowledge, you can navigate the world of banking with greater confidence and understanding. Remember, knowledge is power, especially when it comes to your money.